Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and there's a lot of things to unpack in terms of what is happening within the world, what's happening within the U.S., how is the price cap, the Russian price cap, going to impact it? Now they're talking about a price, Russia's going to roll out a price floor. And then you have the nice little mix of OSPs that have come from Saudi Arabia and how that's going to impact things throughout not only the Middle East, but the reverberating impacts around the world. So we're going to break things into our normal 3 segments. And just to give you a breakdown, in the first one, for those that have been watching us, we've been saying that there was going to be a big build in refined products around the world. And that's and if you go through segment 3 of last week, we talked about the builds that were coming in Fujairah and in Singapore. And one of the bigger ones that we had, now we thought that European gasoline was going to bounce, but I mean, it bounced hard. So it's going to be interesting to look at. And then in the US, it's typical this time of year, only because there's an avoidance of the tax man in pad 3, which is why you normally get sizable drops in crude. They try to manage all of at least in Texas, in terms of the amount of crude that is in tanks, and a lot of that gets moved into product, and now a lot of that product will likely find the international market. So we're going to do segment 1, refined products around the world. Segment 2, U.S. demand weakens again. We really want to look at how much further can this go, because it looks like there could be a bit more downside before we get a little bit of a bump going into the holiday season. And then, I should say, the holiday period between Christmas and New Year's. And then we want to go through Saudi OSP cuts and what they mean based on the region and how that's going to impact underlying flows. So when we look at the overall picture, here you can see total oil and product stocks surplus widened from 2.4 to 11.4. We actually don't see that adjusting lower. We see that actually going higher, and we're going to go through why throughout segments 2 and 3. But we've had a new surge of crude on the water. Not surprising, given that you're getting a decent amount of crude getting pushed in from not only CPC, but also Russia, and some of the flows starting to pick back up. Total crude stocks, land and floating, surplus widened from 13.5 to 16.6. Again, there's a lot of stuff on the floating market, but some of the floating market has moved into transit, and we have seen a decent amount of pivot coming onshore. But one of the key pieces when you look at the surplus versus the deficit, as we've been saying, that the comps get easier. And the reason why we say that is when you look at it, that cloud pinches off in that November-December period, and you see it really tighten. So you can get those increases because, as we saw, we were going to have kind of normal seasonal moves. And then we had some easier comps with crude being one of the largest. But then when you look at oil product stockpiles, the deficit now from 11.1 to 5.2. A lot of this is from Chinese product coming into the market. And we're gonna talk about Chinese flows in segment 3 and how that is going to continue to impact Singapore. And then the reverberating pieces from that, because not only does it show up in Singapore, then it shows up into Fujairah, and then you see some additional getting dumped into the Atlantic Basin. Russia is considering setting that price floor, as we mentioned, on oil sales as a response to the price cap. Regardless, euros are still selling well below $60. So again, it actually opens up countries and companies to purchase this that may not have been able to previously, because you've allowed to legitimize it. Another key piece, Kuwait, we talked about the refining capacity coming online, and we just wanted to hone in on Kuwait for a moment, because they exported its first jet fuel from the new Al Zour refiner last month. Which was obviously November. The facility is designed to process about 615,000 barrels, making it one of the biggest refiners in the world. And that's going to take Kuwait's total refining capacity to about 5.1 million barrels a day. And again, that's the pivot. And I thought this was a good quote from the CEO. It's not going to be so much crude as product when it comes to sales to Europe, the CEO said. An increase in Middle Eastern exports of diesel and other products to Europe is likely to be permanent, he said, with Russia forced to focus more on Asian markets. And that's only going to continue when you consider the price cap that is likely to come out in February of next year in terms of some of these key shifts. Now, one of the important pieces is obviously distillate in the U.S. As we were saying, Pad 3 was going to see builds. Pad 1 was going to continue to be the problem. And then it comes down to how do you get product from Pad 3 to Pad 1? And the only real way to do it is price, which is why you saw that broad differential that attracted new product coming into Pad 1 and the East Coast. And now you saw the prices come down. But with the additional builds in Pad 3 and now still the shortage in Pad 1, you should start to see that discount broaden a bit. Not so much that Pad 1 is going to rise, but Pad 3 is going to weaken, and that'll push more product into either both the East Coast as well as into Europe. So then when we take a shift for a minute to just land storage, you can see the deficit widen from 42.7 to 55.5. And west of Suez, the deficit widened from 31.4 to 36.7. East of Suez, the deficit widened from 9.9 to 14.8. And the real driver was on the floating storage side. So floating storage had a big increase in a lot of different areas. This is a little bit further back, and we'll provide some updates. But it's important to understand that we've seen now floating storage rise, fall again. A lot of that's going to go to land storage. We've seen it in Europe. The U.S. still had some draws, but Europe, when we look at Asia, when we look at Fujairah, we continue to see a fairly elevated number. And now that there's a renewed amount of crude in transit, we expect some of this land storage to fill up as countries try to clear the water side in order to allow a lot of these cargoes that are currently in transit to come stay and sit on the coast. CPC blend loadings for December are revised higher to 1.53 million barrels a day, which is the most in more than 2 years. Now, that's why the Mediterranean and Europe is continuing to see these builds. They're essentially pulling from CPC now that it's back when you look at Libya as well as the U.S. So even though Saudi has cut pricing coming into the Mediterranean and coming into Europe, it's still not as competitive as the other options at this point, which is why we continue to see a lot of this Middle Eastern crude essentially stuck, with Kuwait saying that they're seeing, not that they're seeing a slowdown in buying, it's just they don't see any excess, and they're seeing some hesitancy because demand is so uncertain, which is what we've been talking about, is that demand has been overestimated because people and investors and other individuals running their models are overestimating the economic impacts. And when you look at petrochemicals, when you look at housing, industrial sector, and manufacturing, we continue to see those slowdowns, which is why we cover it in so much depth in the Econ show. So now when we turn to the floating storage market, floating storage, the surplus narrowed from 43.9 to 23.1. In the west of Suez, the surplus narrowed from 4 to 3.1. And then when you look at east of Suez, there's a surplus narrowed from 27.1 to 7.6. Now, that's something where, again, you had a lot of cargoes go into transit. So now it's just going to be a matter of when that transit pivots over and you see those increases on the from transit into floating storage, into land storage. And that's when we're going to get some of these builds as we go through December and really into the first few weeks of January. Crude stocks. Crude had a fall, a draw of 5.19 million. As you can see, the lion's share of it was Pad 3 at 3.62 million, which is, again, very much in line with trying to move that crude so that the tax man doesn't come and count too much of it. There were steady draws across the board. Only build was really in Pad 5. When you factor in the SPR, there was a draw of 7.28 million, but now you're going to start to see that whittle down as we're in December. Crude production had a small increase, but again, as we've been saying, we're at about 12.3, just over 12.3 million barrels a day in production right now. So again, moving closer to where we are. When you look at Pad 2, small draw of 720,000, Cushing, small draw of 370,000. When you look at the 5-year average, that's where we continue to see the lion's share of the shortfalls. Pad 3 is dropped against the 5-year, but again, it's just, even though there's a drop against the 5-year on the crude side, it's actually well above the 5-year on the product side. So you have to look at them together, and so they really kind of balance out. So it's pretty much normal if you consider Pad 3. It's Pad 2 and Cushing that continue to see and drive that those shifts. When you look at crude oil storage in Pad 3, you can see we're right at where we were in 2021. We don't see too much change here. Again, we see it following this trend. The trend is lower, to be clear. The trend is going to move down as they continue to move product out of the market, just again ahead of the end of year tax. Cushing, small drop. This should start to build as, again, crude is left here instead of moving further down. But you can see typically you start to get a pivot at this point. It either happens last week or this week. So the pivot, but it's not going to be this robust, gigantic move, very steady, and follow things that we've seen at this point. And you can just see the steady increases that normally happen just looking at this chart as we go into the end of the year, where we normally have builds in Cushing. Runs were up small, just 0.3%, so we're at 95.5. That even with the small increase in utilization, there was a small drop in crude oil runs, just because depending on the process that's increasing, it can be a net negative for barrels created, especially if you're doing more aromatics, isos, alky. It is a net negative process. So again, it's just small, not too much. And then there was an unplanned downtime that happened, I believe it was yesterday, in California in Chevron's facility. So that will take Pad 5 down slightly, but again, just fairly stable based on where we are. And even if Pad 5 comes down a bit, Pad 3 can come up a small amount and keep things pretty stable around that 95.5, let's say 95 to 96% utilization rate. And when we look against historics, we're still at the very high end of utilization rates. So again, we don't see a huge surge here, just staying fairly stable at these levels, especially now that you're seeing an increase in the distillate storage and gasoline storage. So there's no real reason to continue to run higher, but really hold at these current levels. So when we look at imports, Pad 3 had a big increase of 564,000 barrels. This is more of a makeup number that we were talking about. So again, we expect that to drop back down closer to about 1 million barrels a day. Pad 2, small drop, but of just 8,000 barrels a day, but still very much elevated against the 5-year. Again, flows coming from Canada continue to be the driver. And then Pad 5 remaining lumpy with a sizable drop of 626,000 barrels. But you can still see it's just slightly below the 5-year. And if you average it out, we're still slightly above and continue to see that lumpiness into Pad 5. Pad 3 imports, as we were saying, bouncing to just remaining in that middle ground on the crude side, on the storage. Don't see much change at this point in time as we head into the end of the year, just kind of holding at these levels. Pad 2, again, small drop, still above the 5-year average. We do expect it to move up along those seasonal lines and just stay above the 5-year average and just fairly at the top end of that cloud, as it still makes economic sense to move this into from Canada and down into the U.S. Implied demand, small increase in gasoline, 41,000 barrels a day. Still very much underwhelming at about 8.35 million, 8.36 million. We were expecting to get a bit of a makeup number. It clearly is not coming. We do think it's a little underrepresented, where we're probably closer at this point to about 8.5, 8.45. Still below the 5-year, still below the year over year. So it's just, we're still underwhelming. Not sure if it's really as bad as shown. Distillate got worse, decrease of 106,000 barrels a day. That's a mixture of trucking continuing to get worse and a little bit of a warm up, which helped alleviate some heating demands. And then jet had that correction that we were talking about, down to 1.386 million. And that's just when you start to average it out. Again, we're very comfortable with that 1.45, 1.55 estimate. And then propane had a bounce of 383,000 barrels a day, and that's just that's that timing in terms of when do you refill the tanks, where's some of the flows, where's the demand centers, and it was colder in the demand centers. So again, that's something that's going to remain closer to about 1 million barrels a day, but definitely not making new highs just because we have those issues with the petrochemical demand front. Gasoline demand, as you can see here, very depressed. We don't see that adjusting too much here. Again, you see that normal kind of drop that we typically have, and then the recovery. It's just going to be a muted move. We will get those increases, obviously, for Christmas and for New Year's, but otherwise, we don't expect to see all too much movement in general. We should see a bit of an increase, only because the increase is going to happen as you have companies and gasoline, retail, making sure that there's enough product in tanks to ensure that there is going to be the coverage that is needed as we go into the driving period for Christmas. Crude oil inventory, excluding SPR, has that drop. Again, PADD 2 and Cushing are the biggest culprits for it. Now, the thing that was keeping us elevated was PADD 3, because PADD 3 was well over the 5-year, well over year over year. That has now dropped down as they're trying to minimize their tax bill. And that's going to, again, reverse fairly quickly as we go into the new year. Days of supply for crude, again, it's an important number. It's a good number to look at, but again, it's not the end all and be all. And this is really just being reflected by the drops that are happening in PADD 3, which will adjust quickly as we go into Jan of next year. Products, though, as we've been saying on the product crude side, when you look at both sides of the barbell, fairly flat. Even as you have crude dropping, your build and products, and then vice versa. So again, nothing really to talk about all that much with the things relatively unchanged. Gasoline having a very strong move higher. As we were saying, that we expected this big move. Typically, you get one period of like a pause. Sometimes it's right after Thanksgiving, and then you can see it's also at times right actually in the next week or two. And that's typically that week or two is when is Christmas. And then that's usually when you get that big, not so much a draw, it's just the rate of change of the builds slows, where it either flatlines, comes slightly down, slightly up. And that's going to be driven by the pull going into the market to cover for the Christmas and New Year's holidays. Distillate, big pivot up. A lot of this was driven by PADD 3. PADD 1 had a nice build, still well below normal, but we're going to talk more about that in segment 2. Jet, big reversal higher as we typically have that lull between Thanksgiving and Christmas. And here you can see that we've moved steeper into contango. When you look at just the underlying moves, the back end of the curve strengthened a bit, but really not too much in general. So realistically, we should see contango continue to steepen, especially given the amount of crude that is on the water and the expense for the actual shipping, which again is going to drive prices higher in those later months to try to cover the cost of storage, which again has gone up. So typically as prices go up, contango steepens. And it doesn't have to be because the front month goes down. It can also be because the later months go up, but just given the pressure that is coming into the market. And as we've been saying, we think demand is soft. We don't expect a huge turnaround because of the Chinese reopening. We're going to talk more about that in segment 3. And we talked a lot about that in segment 5 of the Econ Show, which is important when you look at the reopening statistics as we go into the end of this year and then into Q1 of next year. And then the Gulf Coast had a drop in floating storage. Again, that timing delay from floating into imports. And now imports should slow down. And then you'll have this build back to just about normal. You know, we don't see too much of a move. We did get a sizable increase of Nigerian imports, which is what we had been talking about. So nothing surprising on that end. So that's what we have for you on the broad side. In the next segment, we're going to go deeper into the U.S. and some of those key demand drivers.